A big day for the options market with the highest level of quarterly contracts expiring since 2020. My next guest is watching some big moves in the credit space as well. He says put volumes in the high yield index have, quote, exploded. This with the HYG already down 15% this year. Let's bring in Chris Murphy. He's co-head of derivative strategy at Susquehanna. Good to see you again, Chris. So let's just start with options. Does that mean today's market move should be taken with an asterisk?
No, there's been a lot of talk about how is expiration going to impact the markets today. So one thing to keep in mind is we've sold off a lot recently. So a lot of the open option positions are currently higher than where we are right now. The argument would be that if we do continue to trade higher throughout the afternoon and some of those, for example, in the money puts end up out of the money by the afternoon, then you might have hedgers and market makers have to go out and buy back some stocks. So that could exacerbate some of these moves. And certainly options expiration is going to have an impact on the trading today.
But it sounds like you're saying, if anything, this could tilt us to the upside. Like if we are trading to the upside throughout the afternoon, that might cause could I call it a bit of a short squeeze almost?
Yeah, they would call it a gamma squeeze. That's correct, because if you think about it, all, for example, puts that might have been bought a month ago or 2 weeks ago, they're in the money now by enough amount that they're probably fully hedged. So if we go down further, there's not much extra things to do. However, if we do move higher and all of a sudden you don't need as much of a hedge on those in the money puts, yeah, it could have an impact on the upside, yes.
All right. Well, I'm totally going to casually drop that into conversation tonight just to seem cool to my kids. So let's talk now about what's going on in the credit space. People have been focusing on the high yield spreads jumping out to 5 points for the first time in a little while. What are the significant levels that you're watching, obviously, from the ETF side, and what do they tell you?
Yeah, we're looking at the HYG, and that has become a very popular vehicle for exposure. It's highly correlated to the S&P, and it's had outsized moves recently compared to, the premium or the implied volatility that you had to pay for the option. So if we looked at it last week, HYG 30-day implied volatility was around 10%. And we were talking about how it's a pretty good vehicle for exposure. That was a week ago. All of a sudden, now it's at 20%. So those investors who did get some hedges in the HYG last week, volatility is twice as high. So now the question is, now that it's doubled, it's certainly not still cheap. It might even become arguably rich. But it has become very popular, like I said. Put volume, call volume, open interest, et cetera, has just absolutely exploded compared to we were a year or two ago.
And just to be clear, though, would you say it's almost a contrarian sign that once it gets to these levels that maybe the move, the big spread widening has run its course?
Yeah, I mean, certainly you can make that argument for the volatility level. It doesn't necessarily mean whether it's going to go up or down or whatever, but those options are usually pretty inexpensive, but because of what's been happening recently, they're now become pretty expensive. So a lot of volatility is being priced into that product, a lot of eyeballs on that product, and now you have to wonder if it's a little bit overdone.
Quick final question. You say a lot of people are asking you why the VIX isn't higher. Explain.
Sure. That's the biggest question we're getting. In my opinion, just looking at, what's the risks? They're pretty well known. It's almost been a slow motion, hopefully soft landing, but slow motion crash kind of argument. You have higher inflation. The Fed's got to be hawkish. Is it going to cause a recession? We know all these things. It's not, surprising us like maybe COVID did. Another argument, you keep hearing about how the hedge fund community is, degrossed or have taken their positions down. Well, they're typically a user of puts for protection, but if they have degrossed their positions that they don't have as much exposure on, they're not going to have to buy as many puts. That's not going to lead volatility to go higher, and that could be another reason why we're not seeing those outsized moves higher in volatility.
You, in a word, you talk to people over the weekend. You tell me feeling more bullish or bearish on this market in general?
Give me a long timeline, and I'm bullish, always.
Okay.
Near term, I'm unfortunately not seeing it, but long term, I'm very bullish.
All right. I appreciate you taking the question. Chris, thanks for joining us. Chris Murphy with Susquehanna.